Start. Wishing you Happy Diwali!
A very good evening to all of you. Wish you all a very happy Diwali. This is Marketmojo. Wishing you all a very happy and prosperous Diwali and a good year ahead. We've had a tough, challenging year in equity markets the last year. And as you know that we are expecting a better year this year. We've already, I think, in our equity outlooks, have told you that we still hope the next year would be a 15% plus kind of a year. We've had last 1 month, which has been a good month. So, this may just be a start of some good times ahead. But world is very dynamic, very volatile. So, we should keep doing the good work that we're doing to try and make sure that we create capital appreciation for all our customers. Now, today is a very, very important day. This may be one of the most important webinars I have done so far. This is the first time that I'm going to show you the dashboard that I personally see. This is the first time that we are going to review every single product over the last 10 years with you, including the time-wise performance of these products and what product has worked, what product has not worked. I have also done a very interesting analysis to try and see that since 2016, we've identified almost 9 bull phases and 9 bear phases of the market. And during the bull phases and during the bear phases, how does the IP work? Which products work in those phases and which products don't work during those phases? So what are we going to do today is evaluate all our strong buys, all our buys, all our sells, strong sells. We're going to see the performance of that in the longer run and in the shorter run. Then we'll move on to Mojo 1 strategies, where we'll see turnaround, Mojo Stocks, reliable, momentum now, and Mojo Stocks. We will then move on to stock of the week, stock of the month. We will move on subsequently to model portfolio performance. And we'll also, for the first time, show you the performance of Trading 80, a product that we don't talk about much, but there are some surprises out there that we need to show you. So with that note, let's go on to the presentation. I've kept a detailed Q&A session after this. So if you can spare time this Friday, please make sure that you stay till the end so that you can get a full grasp of things. It's a very, very interesting data. It has opened up my eyes as well. So we will, together take this journey and see what we can make out of the huge amount of data that we have. And I have, and my team have really worked hard to try and come out with very strong conclusions of what is going on. Let's move on to the PPT. All right, as I told you, this would be a complete, brutal, honest presentation, complete transparency, the good, the bad, and everything in between. 10 years of data, strategies that delivered, strategies that have not delivered or have underperformed, what has worked and what did not work. We will give a full breakdown of all of this data. Before we move on, an important disclaimer. We emphasize that all investors should use this information on this webinar merely as a resource to enhance their own research and understanding. We are not today giving any investment advice. Nothing discussed in this webinar should be considered as investment advice. We strongly advise all participants to check with certified experts before taking any investment decisions. Market risk warning. Investment is subject to, in securities is subject to market risk. Past performance should not be construed as guarantee for future returns. And investment in equity and equity related securities involve high risk, and users should not invest unless they can afford to take the risk on their investments. We have been running a Diwali offer. We have not disturbed most of our users who are long-term users because of their request. But I'm taking the liberty of showing you on this particular webinar. The only reason for me to show you this is that from next week onwards, the prices for Mojo 1 will go up to 19,999 for 1 year. What we are running currently is a steal of an offer. We are giving 1 year free on 12,999. So in 12,999, you get 2 years of subscription. which is a huge deal looking at what we are going to do from next week onwards. So 12,999 for 1 year plus 1 extra year free is the Diwali offer, which we've not blasted out this time, but this is something that is happening. So it is my job to inform you that we would be closing this offer and the prices will go up to 19,999 for 1 year. I've already covered the agenda. Let's just straight jump on to the score efficiency. So now I need you to concentrate wherever I have some important data points. Maybe I will stay on that slide for a little bit more time so that if you need to take a screenshot or look at those data points in a little more depth, you can do that. We will move on to the first point, which is score efficiency, which is how the buy, sell and holds have done over a longish period of time and over a shortish period of time. So Mojo score is the first thing that we analyze right now. How's the Mojo score been working on the site? Now, if you were to look at the 5-year performance of strong buy category and a buy category, these are absolute returns. If you look at strong buys, the way that we calculate this is that we only look at strong buys. So even if the stock was in a strong buy category and then it moves out of strong buy and goes into buy category, that stock is taken out. So strong buy is only strong buys. Even if it is a buy, it is not considered out there. Similarly, buys are only buys. So a stock which is only in buy category and remains in buy category, that is what we take. And that's why we call this as the index that we create. And we look at this, we've been looking at this index for last 10 years now. So if you look at the 5-year performance of the strong buys, it is at a 872% absolute, which is a alpha of almost 732%. In the same 5-year period, BSE 500 has moved around 140% versus strong buys at 872%. Buys in the same period have gone up by 544% against the index of 140%, which is an alpha of 405%. In a 1-year performance, however, the buys have worked better than the strong buys. If you can make the slide bigger, please. If you look at the 1-year performance, the strong buys have not worked that well. They have underperformed the index. So if you look at 1 year, the index has moved up by around 3.59% and the strong buys have gone up by 2.07%. The buys during the same period, which is 1 year, have gone up by 10% versus the index of 3.59%, which is an alpha of 6.53%. So the takeaway of this is that the strong buys obviously on a longer term basis completely outperform the buys as well as the market by a huge alpha. But in shorter run, there is price volatility and also over convincing ideas may not work. So that's why a buy which has potential of going up works better in a flattish kind of a market is what we are seeing out here. What we also do is that for investors who say, because most of our investors typically may take a strong buy but keep holding the stock during the buy phase and only look at getting out of the stock at a hold or at a sell stage. So we look at buys and strong buys together. That if you were to look at the index of buy and strong buys together, then how the performance would have been. So that means that you may have bought a strong buy, but you did not get out till it was almost a hold level. You were at a buy level. So this works way better than being only stuck to a strong buy or only stuck to a buy level. So the returns of the index is around 600% versus index of around 139% and alpha, huge alpha of 461%. But if you see the 1 year performance is around 10.76% versus the index of 3.59, which basically is a 7% outperformance. I'm going to show you in one slide all of this together, so you don't need to, I'll stay on that slide so you can take a picture of that. So what this clearly says that if we are taking something at a strong buy, we continue to hold even if it is a buy, and then we can get out at a hold or a sell or a strong sell. We don't need to marry into the strong buy कि अगर वो strong buy थोड़ा नीचे आ गया तो I will get out. So we can keep holding it and your duration increases and your returns are more stable. Although strictness of being only in strong buy can work in certain times, I will also do a bear and bull market analysis. But on a longer term basis, if I were to look at a more tax efficient, higher stability of returns, both in bear and bull market, then the strong buys and buys should ideally become one basket, which we should be using. Now let's look at whether we are working well on the sell and strong sell side, because if we tell you that a stock is now a sell, and if you get out or you don't get out, then what happens out there on a sell and a strong sell level? So the 5-year performance of strong sell is 120 versus the index of 13.9, which means it has worked. It has worked better than the, it has worked worse than the index. That means the strong sell is working. And a sell is not working that well. It is 220 versus an index of 139. So there is a, the sell calls have actually generated some better alpha than the index, although the strong sell is a very clear indicator of getting out. Now, if you look at 1-year performance, it is working very well. In a 1-year period, the strong sells have done negative 1.323% versus the index of 3.59, and the sells have done a negative 0.02 versus the index of 3.59. So in the shorter duration, it has worked. In the longer duration, strong sell has worked. Maybe sell has not worked that well. So the sell side validation is, if you see on a long-term basis, you would have saved yourself for 237% if you had moved out from the sell and the strong sell as a basket together. That means that discipline of making sure that you know very well that the downside potential can be very high when you are holding a sell or a strong sell stock into the platform gives you the validation that you need to consider these stocks very carefully when you are not taking an exit decision despite it being a sell or a strong sell stock. Okay, this is the scorecard that you need to look at it. Now, this is exactly what I was telling you. If you see a 5-year, buy and strong buy together is around 600. Strong buy index is at around 872. Buy index is at around 544% absolute return. Hold index is at around 280% 5-year return absolute. Sell index is 220. Strong sell index is 120. If I were to club buy and strong buy together on a 5-year basis, that is 601. And if I were to take sell and strong sell as one category, that is at 194%. So there is on a long-term basis, we are seeing a complete harmony of how these calls typically move. Having said that, the issue is on the 1-year period. If you see buy and strong buy on a 1-year period of the index being at 3.6% has delivered 10.8. The strong buys have delivered lesser than the index, which is 2.1% versus an index of 3.6. Buys have done very well, 10.1. Holds have done very well, 1.2. And then sell, strong sell, and sell and strong sell all have moved in that direction. So the key learning from this, and you can take a picture of this slide, the key learning of this is buy and strong buy is the consistent approach that we need to follow over a longish period of time. Now, obviously, there is a selection bias here. Here, what I have taken is not what you actually would get a return. You can get a return much higher than this. You can get a return much lower than this. Because when I take an index, my approach to taking an index or our approach as a house to taking an index, because there's no other way to do this, is that you say that, for example, if there are in the strong buy category, there are say 20 stocks. I would say that I would invest say 10,000 rupees in all 20. And as soon as one moves out, then the next stock comes in, then I will invest that capital in that particular stock, which is not what you do. You would select stocks or you will miss some stocks, and hence there can be a large deviation in actual returns versus this. There is no other way for us to assess the this thing, because we have to assume that all the calls that we're giving, whether those calls are working for the investors or not, whether it is delivering negative returns or whether it is delivering positive returns. But we have to make sure that we look at this data in a combination way. But as I said, that the returns can drastically vary. If you, let's assume that if there are 4 stocks that gave negative returns and you are only holding those 4 stocks, then obviously these numbers don't matter to you. And let's assume that the top 4 stocks that gave huge returns, you were lucky enough to go into those 4 stocks, then obviously these returns can be way better. Now, the interesting analysis that we did, which was that we analyzed period from 2016 to 2025, and we looked at the buys and strong buy stocks. And we divided this period into 9 bull cycles and 9 bear cycles, where the markets, and we wanted to analyze that what happens when a bull cycle comes and what happens when a bear cycle comes. So for example, if it is in a, if we are in the current cycle, what happens in this cycle versus when we get into a bull cycle, then what happens in a bull cycle. So you should always remember what works and what doesn't work in these cycles. When we looked at the categories, we took all market cap as one category, taking that the whole market. Let's take all market caps as one category. Let's look at whether our large caps work. Let's look at mid caps, and let's look at small caps only. Right? As I said, 9 bull and bear market. Now let's look at this analysis closely. So let's look at the bull market across the 9 bull markets, and I will also show you each market wise, so that you know that it's not that in all bull markets we'll do well. In some bull markets we have not done well as well. But let's look at first of all overall data of 9 bull markets that we witnessed since 2016. If you look at that, all market caps delivered an average return of 55% versus the benchmark of 43%, which is an outperformance of 11%. If I were to look at no market cap specific, but all market caps. If you look at small caps, they have delivered closer to 100% outperformance to the benchmark, 98%. This is only buys and strong buys. So 98% versus 43%. Mid caps were on an average better by around say 10-20% than the index. An outperformance of 9% over a 43% of the benchmark delivered a 53%. But the large caps have actually underperformed the benchmark. So what it is saying is that large caps have not worked well for us during the bull market segment. We delivered a positive return of almost 31%, but the benchmark moved of 43% out there. So the way it is looking like is that the small cap in the bull markets for us has worked very well. The advantage is around 3.2 times of the larger caps in the bull market. Now, obviously, we know in bull market, there is also a small cap rally that comes in. So it's not a big surprise, but the outperformance is clearly visible when you are moving. And this is something that, obviously we can look at, or you can look at as your personal investment strategy. When the market starts moving, you don't look for safer horizons. You typically move into riskier horizons. And with that tool that you have in your hand, which is Marketmojo, obviously you know that we analyze every single listed company. I would typically say the focus then should be very sharply on trying to figure out whether we, at that point in time, looking at our risk profile, can take exposure to smaller companies which have better chances of going up, as we've seen this data, which is now almost a 9-year data that we are evaluating. Now let's look at what actually happened. So if you look at this is the period that we're talking about. Feb 2016 to September 2016, for example, December to Jan of 2016 to 18. So these are the 9 periods that we have seen. And if you see, our returns are in the second column on the top table. And then you have the benchmark. So now there are, although we may have done a great outperformance over a 9-year period, but there are periods in which we've not outperformed the index, even in bull market. So you have a period where, for example, Feb 2016 to September 2016, we delivered 19%, but benchmark delivered 31%. But then you have a period of December 2016 to Jan 2018, where benchmark delivered 47, we delivered 67. So there are these periods that you see, which is, a longish period of time that you see where we've delivered the alpha. In some periods, we delivered positive returns, but we've not been able to beat the benchmark. What this tells you is, if you have the patience of staying invested for a longer period of time, overall benchmark alpha has to be created, will be created, looking at all the data that we've seen, provided you are staying invested in strong buys and buys and doing bit of allocation in identifying which period we are in towards various market caps, from say large cap to a mid cap to a small cap. Now, if you look at the interesting is the market cap wise table. If you look down, if you look at that table, it tells you that most of the time the large caps are not able to beat the benchmark. Now, there is one reason, because the benchmark also is BSE 500. BSE 500 is not actually a large cap index. It is large cap, mid cap, and maybe some small caps also come out there. But it is not just large caps alone cannot beat the BSE 500 index. But if you move down in the market cap and you see mid cap, you start seeing great performance out there. But if you move to small cap, you see a large outperformance coming in terms of the alpha. So if you look at that, you can see very clearly that over the 9-year period, barring 1 year, which was a slight underperformance, you would see a very large outperformance on the small cap side that comes in. Now, again, these numbers look good, but having said that, what happens is the volatility that kills it, because we lose trust in smaller companies when we see the drawdowns out there. So I will also show you a very interesting analysis of the bear market, what happens to small caps. But let's stay here. Disproportionate wealth can be created, but it has to be created from middle level of the market and lower level of the market, is what is clear saying. And clearly that is the problem with most of the guys in the market. Also, if you see, large cap funds and, across the, not just in India, but across the world, if you see how the fund managers are not able to beat the index, because clearly it is too focused on the index being 500 companies, and you may have only 10 large caps that you are betting on to beat that particular index. But as you widen it, as you go on to the mid cap and smaller cap, your ability to beat the index goes way, way higher. Now, one view that you would give me, which I'm going to, come to in the next maybe 3 slides, is that what happens in bear market, because small caps typically do worse in bear markets, right? I mean, that's a view that we've got, that small caps in a bear market scenario, whether they sustain the volatility and the drawdowns are very higher. Let's see what happens. I mean, it just clearly can change a lot of views that you may have out there. Let's look at the bear market learnings. Now, how Marketmojo has worked in the bear markets is actually surprisingly way better than the benchmark. Across all market caps, the benchmark during these 9 bear markets corrected by 17%, we corrected by 8.48%. Small caps, please see the star. Small caps in these 9 bear markets corrected only 5.44%. Mid caps corrected 8%. Large caps corrected the biggest, which is 11%. So although we, in a bear market and a full bear market, we are able to outperform the benchmark, but where the outperformance is highest is in the small cap category, not in the large cap or the mid cap category. So are we trying to say here that small caps give you the best alpha opportunity and best downside risk protection capabilities in bear market? The answer is yes, provided you don't get out. The answer is yes, provided you do not get out of it and you have the stomach to look at that volatility and say that I'm sure this is going to, when it rebounds, because when it rebounds way more faster. Now, we are seeing suddenly a array of small cap stocks. If in this corporate earnings, if I were to see, some of the best corporate earnings are coming out from the small cap stocks. Right? Because their ability to bounce back, their cost management, their growth rates can easily be managed than moving a very big ship, which can be a large or a mid-cap company. So what we are seeing, a change in this earning season, is a lot of small and mid companies coming out with way better results than large cap companies. So it also kind of gives you an indication of a cycle move that can happen during these times. But very interestingly, and I'll go down to the details of the data now, that in bull market, when your alpha is the highest on the small caps, in bear markets, accidentally, your downside protection is also the best on the small cap category. As far as, I'm not talking generic market, I'm talking about the Marketmojo algorithm. I'm talking about the Marketmojo strong buys and buys, right? So I am qualifying this by saying that I'm not talking the index, I'm not talking all the small caps, I'm talking about the strong buys and the buys, and my whole analysis that we do is only limited onto that number. Let's look at what happens in bear markets. Now in bear markets, we have done way better across market caps. If you were to see, if you see large caps in bear markets have a good alpha, mid caps have a good alpha, and small caps obviously has the best alpha. But across all bear markets, end to end, we've been able to do better than the benchmark across these particular categories. So what you see, performance of buys and strong buy in the first table are the 9 bear market scenarios, where you can see the benchmark return is from highest minus 38% to minus 16%, minus 16%, minus 19%. And you can see the returns of the buys and strong buys of our whole market in the second column, which is the returns, and then you see the alpha, and you can see to what duration that bear market lasted. One of the other analysis, which I'm not going to get in today, is that if you see the average duration of the bear and the bull market is completely different. The bear market average durations are very smaller. The bull market average durations are quite bigger if you were to compare that. Now, if you come down on the table, if you see market cap wise, barring 1 year in large cap, it has outperformed the bear 9 scenarios. So is the mid cap, all outperformance, and in small cap, apart from one category, you've seen an outperformance out there. So, very important set of data I've shared with you today. It basically, if I were to look at insights of this data and tell you what I'm reading out of this data, give me the screen, please. I'm clearly seeing out here that small cap as a strategy, if you were to follow with discipline, and you've seen how the correlation falls when you go into a sell and a strong sell. And if you have the patience to sticking on to it, can be a very big alpha generator and also a preservation tool during various market scenarios. And I'm only talking about the strong buys and the buys of the solid quality companies. That sometimes we feel that, the volatility is too much. Those stock corrected 6%, 3%, and it'll further go down, even if it is a strong buy. But clearly on an index level, if you see, that is not something that we're seeing. Now we are going to go into all our products. Very interesting analysis here. Something's working, something's not working. I'm going to cover all of this. Hidden turnarounds, momentum now, reliable performers, Mojo Stocks, stock of the week, and stock of the month. What is happening here? If you see hidden turnarounds, please give the screen. Yeah. If you see hidden turnarounds, the CAGR of hidden turnarounds since inception has been excellent, 31.7%. Benchmark during that period moved 14.7%. This is a CAGR outperformance of 16.3%. The success rate of calls that did well are 64%. Average duration of these calls has been 240 days. If you look at all the years barring 2025, where the return has been negative 13% because of it being a turnaround, the benchmark moved up 5.6%. But otherwise, every single year, apart from the first year that we started 2019 and the last year, the CAGR is a handsome CAGR of 31.1%. Now, you must understand turnaround is one of the riskiest possible product, primarily because it looks at companies who've delivered negative returns for certain quarters and they've just come into positive. So there is a high risk level in this particular product, and a 64% success rate seems to be a very, very good success rate for this particular product. But this, we'll also see whether this is a bear market product or a bull market product. Let's look at that. Let's move on to momentum now. The momentum now, a CAGR of 62.2%, the benchmark of 14.7 has not worked in 2025 because it's a momentum and there is hardly any momentum in the market. Alpha is 47%, success rate of 52%, average duration is closer to 3 months. Now, despite this being a very, very good product, it seems to be more like a bull market kind of a product, which is done around 10% negative versus the benchmark of 5%, underperformed the benchmark by around 16% in the current year, which is 2025. Otherwise, last year it did around 63% versus a benchmark of 14.5. And before that, and every year it has beaten the benchmark very handsomely, especially in 2020, where it did around 218% versus 16.8%. Now let's look at reliable performers. 59.1%, benchmark of 14.7%. Alpha over the benchmark is 44%, 65% success rate, 196 days is the average duration. Again, barring 2 years, which is this year and 2019, where the IP did not work, it has delivered, although delivered positive 2%, but it has not been able to beat the benchmark of 5.6%. Let's look at Mojo Stocks. Mojo Stocks, which is our oldest product, 35% almost, versus the benchmark of 14.7%, 61% success rate, average duration 120 days. Worked every year barring this year, which is 2025, with a negative return of 6.2 and a benchmark of 5.6. Consistent strategy, but if I were to look at, let's just finish stock of the month. CAGR of 24.1%, benchmark of 22, alpha of 1.5 has not worked this year, a return of minus 10.6 versus benchmark of 5.6. Average duration is almost a year and success rate is 63% in this case. And the product that really needs improvement, which is our youngest product, is Stock of the Week. Incidentally started since the time that the markets has been down. Stock of the Week, CAGR of minus 7.6%. Benchmark has been zero almost during that time. So you know that this, it's been launched in a period where the benchmark has just not done well. Alpha is minus 7.6. Success rate is very good at 58%. Average duration of 152 days. 2024, it generated an alpha of 7%, but in 2025, it has generated a minus 4.5% return. Let's look at all of these together. Hidden turnaround. Momentum now 62, 59 reliable. If you look at this, the highest success rate is highest return is of momentum now, but it has a success rate of 52. The thing that really would interest me here is reliable performers, which according to me is coming out very, very strong, which is at almost a 60%, but the success rate of calls is at around a 65%. So momentum now is a bull market, seems like a bull market product, which needs momentum in the market for it to perform. And so does the shorter duration calls like stock of the week, because you're taking a call of 3 months, 4 months, and it requires a momentum to go into those short duration sprints, because the market can be volatile and can chop out most of your returns. So both of these, according to me, will start working very well during a market turn that might happen. If I were to invest in these products on an all duration basis, I would still hang my hat on number one, reliable performers. And then I would also look at Mojo Stocks out there, which can give me that particular alpha. Okay, let's look at calendar-wise returns, that what happened across calendar-wide across all these strategies, and this will give you a clear idea of the outperformance alpha. The greens and the reds are the alpha. In this, I know it's a lot of data. You can take a picture of this and you can analyze it later, but let me quickly show you, what has worked and what has not worked. If you look at 2025, practically, most of the strategies have been not able to beat the benchmark, barring one strategy which has been reliable performers, which has ended up in positive, but otherwise we are typically on the negative side with a benchmark, which is just, this data is of as of yesterday, so the benchmark looks to be at around 6% up. Apart from that, 2024, hidden turnarounds did a 30% benchmark, 44% versus 15 on the benchmark. Momentum now did 63% versus 15% on the benchmark. Reliable did 72% versus 15% on the benchmark. Mojo Stocks did 71% versus 15% on the benchmark. Stock of the month did 34% versus 15% on the benchmark. And stock of the week did 2% versus negative 5% of the benchmark, which is a 7% alpha. So if you were to look at these numbers, it clearly tells you that we've got an outlier year in 2025 where the strategy is not worked as good as it has worked over the last 5-6 years. Now let's look at what has happened in the bear market and the bullish market. So we've taken the same 9 periods and looked at bullish market returns and the bearish market performance of these 6 products. So if you look at in the bullish market performance, let's look at that first, which is the first table on your left. If you look at that, it shows you that the product that has worked very well in bullish markets is reliable performers, which is generated a 22% alpha. Second, in the bull market has worked very well is momentum now, which is at a 20% alpha. Then hidden turnaround at 15%, and then Mojo Stocks at 13%, and then followed by stock of the month. Stock of the week, we only have data for a year and a half, and hence I will not look at that data right now because it's unfair to compare stock of the week with 6-7 years of data of other strategies. But interestingly, if you look at the bear market performance, in bear market, turnaround has been the best performing strategy with 18% average return. Momentum now is with a average outperformance of 5%. Reliable performers 12% versus index of 4%. Mojo Stocks 9% versus index of 2%. And stock of the month 13% versus index of 4%. So what has happened here? Again, can I have the screen please? What this is again telling you is most of our hidden turnarounds are small caps. So what is coming out again very clearly here is that if I were to look at 2 of the winners out here, which is consistently beating the benchmark with a very handsome return, although Mojo Stocks is something which is our most powerhouse product, I would say hidden turnaround and reliable performers impresses the data, at least the real data, at least the most. In bullish market, both hidden turnaround and reliable performers have done a average return of 33% each versus, index of say 11% and 18%. So that means that if I were to look at taking a conservative call in bullish markets, I would typically look at a reliable performers. If I were to take a aggressive call in bullish markets, I would look at hidden turnaround. If you were to look at bearish market, and I think what is happening here during the bearish market, I think the market starts rewarding the positive results more than the consistency of profits. So market starts rewarding negative, and then positive results way better than positive results. That is clearly the trend that is coming out. If you look at the hidden turnarounds otherwise, normally you're speaking in bearish market, a hidden turnaround should not do that very well. But incidentally, if I were to not look at the current year as an outlier, because it can, and that is the reason I looked at 9 cycles of market, of bear market and bull market. What clearly comes out is that if you have the staying ability, a hidden turnaround can also be a capital preservation in bear market scenario and can be an outlier on the bull market scenario. But if we were to look at a safest strategy you were to follow across, it can be reliable or Mojo Stocks out there. And as I said, I would discard stock of the week from this because it is just, but it's my job to show you that it's not doing well right now. But it is something that is a very new product, and the birth of this child was in gloom. We are using the same set of parameters, the same IP out there. It's only a matter of time. It has to see one good cycle to start showing up. So very interesting analysis. Another very crazy analysis I'm going to show you now that I move on to model portfolio. Now, if you look at the model portfolio, we manage a very, very large AUA on the model portfolio. Now, if you look at portfolios that are profitable, 87%, portfolios which are outperforming, 62%, and people who are sitting on cash is around 28%, but that 28% shows in my performance because if they're not investing, I can't help it, but I have to take ownership of the performance out there. Now, obviously, the key insights that we've seen even in Infinity is that a lot of people try and time the market and say that, I'll give you the money, but I will not invest right now. But that is your wish. And, I can only tell you that sitting idle always will make you miss the rallies. But if you see the data out here, let's look at the 5-year strategy comparison. If you look at the 5-year strategy comparison, aggressive has delivered a 25.2% return, which is a 5-year CAGR. 5-year alpha is around 6.2. 1-year return is 2.1%. Market is at around 3%. But all 3 model portfolios have delivered positive returns even in the worst year that we've seen, which is the last year. Moderate has given a 5-year CAGR for 24.1%, which is very close to 25.2%. 5-year alpha is 5.8% and 1 year is 1.3%. Conservative, to me, is the most surprising, has delivered at 21%, which is a 5-year alpha of 3.4% and 1 year return of 1.2%. Now, if you look at this particular slide, I think this is where we need to work a little harder. I would rather see a much larger gap on conservative and aggressive. We have done a lot of innovations in our Infinity strategies and all, and we are going to relook at how, we are going to address the aggressive portfolios, because I personally believe that aggressive portfolios, because of the risk that the client is taking, deserve a much higher CAGR rather than at a 25%, which is very close to moderate. There's hardly any difference. There's hardly a 1% difference on a 5-year CAGR. So that's work defined for us. How do we make sure that we go much more aggressive on the aggressive portfolios? And I think, conservative, according to me, looks the best out here with that kind of risk that you take. A 21% 5-year CAGR is an excellent CAGR, which is a 5-year alpha. Now, I'm coming to a very interesting part of the presentation, which is trading 80 strategy. Frankly, I had never looked at this data because I never believed in this strategy. Because as you know that we are more fundamental people, and we created this because of perpetual need from our investors to give them a trading product. So I must confess that this deeper analysis on this strategy I'm doing for the first time. There's no shame in doing that. This was lying on one side. We knew that users are not using it that much. There was not much feedback coming on this. So this is something that we are seeing it. I'm seeing this along with you, if you can read it like that. I saw it for the first time around a week back when I started looking at this data. So far, we have done around 2,703 trading calls. As you know, we have daily indicators and we have weekly indicators. So 2,703 trading calls have been done so far in this particular product. Now let's look at the exact summary and then we'll get into the details. Surprisingly, this works very well. So average return per call has been 1.03%. Now when I say average return per call, it is buy and sell call together. So buy calls and sell calls, total calls, which is 2,700 calls, the total return it generated. So average return per call has been 1.03% across 2,703 calls. That's a huge thing. And number of days, average duration is 13.8 days, because sometimes we pull the daily call ahead and we can pull the weekly call also ahead if we feel prospects are changing. Now let's look at the second column, which is type of call. If you look at the type of call, the buy calls, the successful calls have generated 6.78% average return per call, but the calls that have not succeeded have generated a negative 5% average return per call. If you look at the sell calls, the successful sell calls have generated a 6.6% average return per call, and the unsuccessful calls have generated a 4.5% negative average return per calls. If I were to divide these 2,703 calls across calls that we gave, which were daily calls, and calls that we gave, which were weekly calls, those are the two numbers that you see down. 1.88% positive average return per call is the daily indicators, which is 42% of our calls. 58% of the calls were weekly calls. They have delivered a 0.42% return. So clearly what it is saying is that daily calls are working way better. Although all the calls are working predominantly, I'm not saying that all the calls, but in the sense overall the calls are all working. But the daily calls are working almost 4 times better than the weekly calls. Now let's dig deeper into this data. And let's look at the daily calls. If I were to look at total 42% of the daily calls, their average duration was 6.6 days and they delivered a 1.88% average return per call, which is in a 6-day duration. Weekly calls, average duration was 19 days. The calls were 1,572, which was 58%. And they actually delivered a 0.42% positive returns. So what this tells you is daily indicator delivers almost 4.5 times better returns and nearly 3 times faster because of the average days of 6.6 for daily and 19 days for the weekly calls. So this is a very interesting analysis that comes out here. But let's understand. Let's go further deeper into this. So the mode that we've achieved out here is that the daily calls are working way better than the weekly calls, and it's a good news that it is working. 1.88% average return per call, or the daily calls, and weekly is 0.42. Let's go further deeper. Sell calls. Now we segregated the buys and the sell calls. So sell calls are delivering again way better, which is 2.7 versus buy calls, which are delivering 0.48% positive returns. So sell calls were 25% of the calls. We gave 671 sell calls. Average return per call has been 2.7. Duration has been 12.1. And buy calls, average duration was 14 days. There were 2,032 calls, which is 75%. Most of the calls were buy calls that we gave. Delivered a positive 0.48% return per call. Best combination that we've seen here, and I'm going to give you a combined combination of all of this, but the best combination that we've seen is daily sell small cap calls. If you were to just filter all of this on a daily sell small cap calls that have delivered per call 4.41% return across 272 calls. Now, you have to be very clear, good data, excellent data, but also you have to say you're taking a sell. So you have to look at how many of these stocks are in FNOs and so on and so forth, right? Because obviously that's where you can take the positions. It's not a cash market game altogether. So, but what clearly comes out is that this product really is a hidden gem. It works, but it has to be played in a very selective way where you're looking at the sell calls and you're looking at maybe a smaller set of market cap where the duration is smaller. And if you're looking at weekly and daily calls, the daily calls are working way better than the weekly calls, provided you can obviously extend that call, because sometimes the call doesn't close in a day. It goes for 3-4 days out there. Let's look at market caps. Small caps deliver 1.69% average return per call. 37% of the calls that we gave in Trading 80 were small cap calls. Large cap delivers a 0.66%. 35% of the calls were large cap. And we gave 27.7% of the calls, which is mid cap, which is 0.59. So large cap and mid cap average return per call is very closer to 0.6% average return per call. Right. Small cap, if you were to see, is almost 2.5 times better than large and mid cap Trading 80 calls. And there also daily calls work better and sell call works better. So the combination that we've seen working very well is daily, sell and small cap. So these are the top 5 combinations that I'm giving you. Daily sell plus small caps, which has delivered a 4.41% return per call, 272 calls we did. Daily sell plus mid cap is number 2 with 2.76% return per call and 60 calls we did. Daily buy large caps is third, 1.28% return per call, 255 calls we did. Then comes daily buy plus small cap, which is 1.42% return per call and 232 calls. And weekly sell plus small cap comes in with a 5.69% return calls with 62. Weekly sell and small cap. So clearly, daily sell and weekly sell, small caps is where the first category is. Then daily sell mid cap comes in. Then comes in daily buy large caps and daily buy small caps in that particular order. So as I told you, very interesting analysis out here. Now, let's go to the learnings. we've seen that small cap buy signals significantly outperform across most of the market phases that we've seen. And I'm saying not all, most of the market phases. Exceptions can be there in any market phase, but it can create largish alpha. At the same time, it can be, which is very contrary to the belief, it can also help you create a preservation strategy during bad times. Small cap delivered 3.2 times returns versus large caps in the bull market scenario. There is a protection paradox that we spoke about, which is small caps also delivered better returns during bear market protection periods. Consistency pattern holds across market cycles, so it's not a fluke that I'm seeing on the data. This is across almost 18 market cycles, 9 bear, 9 bull market cycles that I've seen. Having said that, no past indicators can sometimes, they don't work, or maybe they won't work. So it's not that we are saying that this will get repeated all the time, but what our data tells us that across all 18 market cycles, we've seen this learning. And there may be, if you're an aggressive investor, maybe a case that you may look at a very small cap specific portfolio, not to dip in and out, but to stay consistent over a period of time. And we are seeing this kind of a pattern even in our, Mojo Infinity portfolio, which I'm going to review on Tuesday, where the highest performing portfolio is the small cap portfolio. So we are seeing that trend coming in. But having said that, that is as per how you assess your risk profile, and you need to take proper advice on that. Most broad themes, long-term investing works. Volatility is in the price. Quality over quantity. Know what to avoid. But there are also some learnings that we need to know, which is our story, where we started, where we are, and where we are going. What has worked is that we've delivered good long-term alpha generation in the history of Markets Mojo. Clearly, score gives a very synchronized way of looking at things from strong buy to strong sell. So we've shown you that synchronization out there. Both buy and sell side of the score seems to work very well in a longer term period, and obviously consistent methodology that compounds over a period of time. The core truth out there is that our system identifies extreme winners and losers with remarkable accuracy over a period of time. The current challenge is 2024-25 underperformance is there across most of the categories. The medium term 1 year results need improvement, which is something that we very well know. And I personally believe that the path forward for us is not to rebuild the system, not to shake the system, but to do minor calibrations in the system, as we spoke about, that, what can we do to try and make aggressive more aggressive and get the performance indicator out there. We are not looking for a core change of philosophy, but minor calibrations will always happen. We should focus on magnitude of wins versus frequency of wins. We should look at when we outperform in a margin which washes out the underperformance of the previous year. That is what we need to look at. And we need to maintain discipline through various market cycles. Because the difference between noise and signal is only one, which is time. So that time you have to play on the longer run. So what you saw today was 6 strategies, full 10-year track record. You've seen bull and bear market explosions and struggles that we showed you. We've shown you strategies which have delivered 65% CAGR. We've delivered 0% alpha as well. And obviously, we've shown you what works, what doesn't work. I want to make this as a monthly format. Now, what I'm going to do is that I'm going to review this with all the clients on a monthly basis so that we can have a much more sharper, intelligent discussion of what is changing and how we're seeing trends changing. But obviously, process, there's no perfection. There's always improvement that we are going to keep doing. But having said that, honesty and trust is the most important thing with which we have decided to do this review with you on a monthly basis rather than a review on a once a year kind of basis. With that note, my last slide, final call. We had done a Diwali offer of 12,999 for 1 year. Plus, we are giving 1 year free. This offer will get over soon. The prices will go up to 19,999 for 1 year. Currently, you're getting 2 years in 12,999. So if you want to subscribe, please follow the link and do subscribe as soon as you can. We are going to up the prices to 19,999 for 1 year going forward. All right. With that note, we can get on to Q&As. Mr. Rishabh Parekh, what is your opinion on a good CAGR one can expect by investing equally in all strategies in Marketmojo, long-term, 10-year plus? Sir, I think long-term, 10-year plus, we expect the markets to be in a double-digit kind of a thing, and I think you could expect and we are not allowed to talk about any projections out here, but I can only tell you that if you were to look at the outperformance of the last, all the products that we've shown you out there. So some products have done a very huge outperformance, some have not done that huge outperformance, but I think you should expect beating the index with a very smart alpha. I'm not allowed to give you the numbers of future projection. I'm sorry for that, Rishabh. Ayush, thanks for a great algo-based feature, but I want to understand why and how score changes so fast and company scored 85 suddenly comes down to a hold or a sell. As far as I know, Mojo Stocks criteria is rigorous and it is checked and signed by a team. Then why so volatility? Example, Ashoka Buildcon, Mastek. I think, Ayush, we have, there are very, 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 very rare scenario where a strong buy will come down to a sell or something. There has to be backed by a very, very weak results that might come in out there. Still, an 85 stock coming down to a sell, I mean, you should surprise me with what stock you're talking about, and I can investigate and find out what happened to Ashoka Buildcon or Mastek. But from 85 to sell, when you're saying sell, we're talking about less than 50. So you're saying that the score dropped from 85 to say less than 50. And this can be with a very, very negative results that might have come out, but it is very tough. It doesn't move that much. If you want, maybe next month I can tell you average duration of stocks remaining in each basket, so we can cover that point. It's an interesting thing that you've raised out here. But predominantly the moves are not that much. Now what happens though is that things that can move on a quarterly result basis is every quarter their ratings can change. But most of the fundamentally strong, good quality companies where the quality score is very high are lesser vulnerable than average quality stocks, which may just, because the result is bad, so the quality of the stock also falls. So quality is a 5-year parameter. That also falls, and then there's a double whammy effect on that particular stock. But if the quality is good or excellent, it doesn't break that much because our weight on long-term fundamentals is way, way higher than technical is very, very small weight out there. So, so technicals don't move at all. The weight, it may fluctuate by like 2-3 basis points. The stock may keep jumping here and there, but it doesn't change the whole grade of the stock. Technicals never can change the whole grade of the stock that well. But we will, maybe in the next presentation, I can cover the average life of, or what kind of abbreviations we've seen in strong, in drastic score movement, either downwards to upwards. Now, I can tell you that one stock, I have seen a very, very drastic movement, which was at a 45 score without taking the name. And it came to a 75. And that was because of exceptional CFT improvement. And that stock is up only almost 25% in 3 days or 4 days. So there can be very, very high result improvement, which can take it up. But in these kind of stock, what happens is that because the result is so well and it shakes the 5-year parameter, the quality level also goes up. If the quality and the CFT level both go up, then there's a drastic movement that comes in. Bala sir, hi Mohit. Your data across 9 bull and bear market was interesting. Thanks for the same. The data showed that large caps underperformed the benchmark. Does that indicate that the IP needs some more of some form of tweaking? Please share your thoughts. It's Bala sir, your observation is right. It also concerns me that why the large caps across bear and bull market have not been able to beat the benchmark. But as I said, maybe what we can do together is try and look at a much shorter benchmark, because it's not fair for me to compare the large caps with the BSE 500 benchmark. We've compared it with BSE 500. Maybe we can look at a Sensex benchmark, because that is a true large cap comparison. But because we were doing all the comparison with BSE 500, we said let's look at BSE 500. The BSE 500 has around 250, or maybe I think its first 100 is large cap. Correct me if I'm going wrong on this, but maybe Bashir, can you call Sunil, please? BSE's first 100 large cap, then 250 is mid cap, and the remaining are small caps. So if I were to compare BSE, that whole format of the constituent, there's a lot of mid cap and small caps, and I'll give you this number. I've called Sunil. I'll give you this number right now. That what is the the construct, Sunil? I'm BSE 500. First 100 are large caps, right? Or 150? Yeah. First 100.
First 100 is a large cap, 101 to 250. That is
250, right? Yeah. So that exactly. So first 100 are large caps. Then from 101 to 250 are mid caps, and then from 250 onwards to 500 is small caps. So now, if I were to compare Sunil, I'm so sorry, I'm trying to drag in this, but I was saying that we should look at the large cap performance with a shorter index. We are comparing our large cap call success rates and performance with BSE 500. I'm saying that BSE 500 is a large constituent of more than large cap. It has a constituent of mid and a small cap out there. So I think very interesting question, Bala sir. But before we jump to a conclusion, let's once compare it with a shorter index and see what happens out there. Maybe a Sensex, or for that matter, even BSE 100 we can compare it with. BSE 100 will be a very good comparison because that's all large caps. So we should compare it, because out of 500 we are basically hitting these large caps on 400, which are mid and small caps. So we should do that comparison before we reach to any conclusion. Mr. Devgan, hi Mohit. Some of the hidden opportunities momentum now in US are really booming. I have been able to pick substantial gains there. Let's do a good global webinar to eagerly awaiting. I completely agree, Devang. I'm going to include every country from next, this is the first format I was trying to do, but next month onwards, we will pick up every country. I understand what you're talking about. Some of the other countries are doing very well. I was looking at US, I was looking at China, I was looking at various other countries, but I will pick that up. Next month, we will do or maybe if you want, we can do a global webinar as a separate webinar series for all global investors. Let's do it as a separate webinar, because Indian investors want to go very deep. Then, we only have a 1 hour time. You guys leave me half then in between, and I feel very lonely when you leave me. So I will do a separate webinar which is on global, but India will go into the same rigor of depth. We'll go on the global as well on the same rigor of depth, but we'll cover all other countries. Anjali, what made your IP2 underperform in the last 1 year, whereas it should have become more mature and give better alpha instead? Age doesn't essentially make you wiser, Anjali. So basically, this is equity markets. So what happens in equity markets is that if you are continuously outperforming for 6, 7, 8 years, you can't say that just because somebody has outperformed for 6, 7, 8 years, now for the next 20 years at least you should outperform because you've matured. It doesn't work like that. There are market cycles where your IP performs. There are market cycles that your IP doesn't perform. For example, let me give you an example. Even in bull market, it's not that we outperformed all bull market. On the 9 bull markets, we outperformed 5 bull markets. In bear markets, we outperformed almost all 9. So there are chances where the IP will not outperform, not underperform. The essence of the message, what the messaging that you need to take is that on a longer duration basis, if you were to stay invested with the straight mindset of buy and strong buys, you may underperform for a year, you may sometimes underperform for 2 years, but when you outperform your alphas, I've shown you. those will be huge. But those are patient alphas. Those are not jumpy alphas. And there is no guarantee that the outperformance, because we've spent 10 years in the market, the outperformance or the underperformance may not come. Underperformance is always a part and parcel of wealth management, of investment management. You cannot avoid it. You should embrace it with humility. You should embrace it with the honesty, and you should keep working, because you know when your day comes and you believe in your IP, when the day comes, the outperformance is going to wash out a year, not just a year, but on a 5, 6, 7-year period, you've seen the outperformance in terms of CAGR, right? We look at long-term CAGR in investing. We never look at what happened in 1 year and all this stuff, because that is something that will make us take stupid decisions, because we will tweak something which is working very well just because we were in a phase of market, and we will spoil the magic of the whole IP. So, as I said, are we looking at tweaking? We always look at tweaking. We have been looking at tweaking for every year. We learn something and we tweak it. And that is the reason it has matured so much. But because of that tweaking, will it never underperform? That never happens, essentially. Vineet, Moj sir, excellent analysis. Thanks for putting this effort. My query is, during bear market, Marketmojo recommends to switch to large caps from mid caps and small, and most of small and mid caps move on to hold and sell status. This is the reason most of the investors won't have the trust to hold on to the small and mid caps. Your views, please, and how Marketmojo is planning to address this in future bear market scenarios. Vineet, excellent question. Excellent question. So I'm going to do a deeper analysis that in bear markets, how many of our calls have. So if obviously we are saying that in bear markets, the small cap and buy and strong buy category have outperformed. What you are saying is that in the bear markets, the small caps typically move towards hold or sell, which may not be the case. Let me see the number of calls out there. So when I was doing that number, you read my mind. I was also looking at that. Is this an impact of concentrated some calls, or this is, our calls have remained the same, or we have good enough calls for investors to invest in? I promise you I will get into this, Vineet, and I will give you an answer. But right now I don't have a data-driven answer to this. Raghu, it would be useful to compare the mid and small cap categories with better indices representing their cap levels. For a common category for cross-cap comparison, it would also be useful to see a comparison with Nifty 50 rather than BSE 500, which is a mix of all market cap categories. You need to also relook your sell and strong sell categories where there's not a significant alpha with respect to the benchmark, clearly indicating that there is some introspection required out there. Yeah, you're right, Raghu. We can look at that. I can go deeper into that. I understand with the one thing I clearly agree that we may have to do a different cap comparison and a different index level comparison. The cells are working better. Sorry, the strong cells. The cells are working, and I'm now getting confused. The cells are working better than the strong cells, is what we've seen. So we should also look at those quality of companies and see that whether these are the companies which are the punting companies, where they are baseless volumes or people are speculating out there. Because sometimes the speculations can give you that kind of a move, even if the quality of the company is not good. What we should look at is essentially the success rate. Sometimes what happens is a strong sell company delivered 200% return. The other small cap companies actually did very well. So is there a concentration of small caps that are strong sells which are not working? Or most of the small caps are, because it's not that they are beating the holds or buys, or they are just beating the benchmark a little bit, right? So it's not that they are great performers. But is there concentration of some call working and some calls not working? And also whether these are speculative, that 7 rupees, 10 rupees, 20 rupees counters which are moving. So we can get deeper into this. Now that we had done this one presentation, the excellent suggestions coming in, we can get deeper into this. Santosh, can you make a Mojo index consisting of 5 different strategies of 50 stocks, then compare it with Nifty 50? So this is the Mojo index only we made, sir. Mr. Ghosh, the way that we do it is that Mojo Stocks ka we make a Mojo index, then turnaround we make a index, then momentum now we make an index, then all these what returns I showed you is of the index. So we make the index and then we compare it with the benchmark. So we exactly do the same process, sir. If you need to know anything deeper on that, please write to me, or we can address it in the next webinar. Mr. Ganesh, my appreciation for you to gracefully accepting where you have gone wrong. Absolutely, sir. There's no disputing it. Where we've gone wrong, we've gone wrong. Where we've done good, we've done good. Where we're improving, I think you may have liked it sometimes. You may have disliked me sometimes, coming ahead and telling you that we are trying to improve this, and you're saying that why didn't you prove it before? But we are on a continuous improvement path. We will be for the next 10 years also. We'll keep doing our best work to try and deliver those returns. But where we've underperformed, we've underperformed. There's no questions on that, sir. Thank you so much for your comment. Mr. Sundarajan, Mohitji, great presentation. What is your take on how IT companies can perform till March 2026, considering the US tariffs and H-1B visa swords hanging, sir? I cannot take sector-specific questions. I think, but I have a very, I have a vision on how IT services will evolve. If you guys want, I can do a separate presentation. But I personally believe that the whole sector, and I'm talking about the relevance of AI in service sector, is up for a very, very big disruption. And we are in a very, very difficult stage as the country and we have to really introspect that we have to move from the lower level, base level coding jobs to value addition on the AI side, which India as a country has not been able to move that fast. So I personally believe that IT services is up for a very, very big challenge in the country. Employment of people in that particular sector is up for a challenge. And we should watch this sector very closely. And we need to make sure that as companies like we embrace, and maybe at your level as well, you embrace AI in the best way. And, if you want, I can do a deep dive into AI tools and how they can impact also that. That is not a part of Marketmojo, but I can do that if you want to try and give you a view on what's going to happen. But I think for your children, tell them to be ready for the next wave. I've seen two large waves in my life. One was internet boom, which came in and gave the opportunities to India and gave a lot of jobs. And this is the second boom, which is the AI boom, which according to me will take those jobs away. And we need to be AI ready, whether it's our business, whether it is our job, whether it is our children, whether it is our spouses. We need a very, very deep dive and training on that. Personally, to tell you, I am completely deep diving into AI and trying to understand that, trying to implement that. I actually was in Harvard for a month to try and understand the trends that are happening out there. And we are trying to see how this can shape up the whole country, not just the companies that we are looking at. But it's a very, very challenging and differential topic that we should discuss maybe on a different platform someday. Mr. Umakant, Mohit sir, very interesting data and a lot of analysis, but the question is how to identify the market cycles beforehand to select the stocks from market cap under various strategies. Your team never talks about the market cycles we are going through. What is your say on that? Mr. Umakant ji, very right. Introspection, everything looks that I could create 18 market cycles, 9 from bear and 9 from bull. But it is our challenge to understand which market cycle we are going in. I'm happy to tell you that Sunil and me are working on this. We are putting in parameters to see whether we can predict a market cycle. We'll have to go for the next 20, 30 years and put parameters and see that the parameters that we put, whether they are actually predicting the market cycles well. That can be a very big value addition for us to adopt in our IP. We have started our thought process on this. We haven't started working on it, but it is on the top of our agenda to figure out how we can predict what market cycle we are in, and basis that a lot of things can get aligned. Very interesting thought process that you have, completely aligned with us, sir. You take the last question, please. Anup, typically an average investor holds a Mojo stock till it is a strong buy or a buy category and exits when the stock comes to a hold category. But by then a substantial profit is already wiped out, and then why not there should be a profit booking range for all Mojo stocks? Anup, we don't know when the investor is getting in and when the investor is getting out. Typically, that is the issue. So profit booking strategy cannot be at a strategy level, has to be at a client level. But if you want, I have not done this analysis that how much is the money erosion that happens from a strong buy to a buy. So if you want, I can do an analysis to figure out that if the stock is a strong buy and goes to a buy and a hold, what kind of a capital erosion that happens out there. But again, I can do it at an index level. I won't be able to do it at a stock level because you may be holding a stock which may be an outlier to that. But if you want, I can do an overall analysis and look at that. I definitely will look at this, Anup. But profit booking and loss can happen once you have a portfolio approach because I don't know what price you bought it. I don't know what price the other investor is getting in. So for example, if the price was say 100 and you bought in, now the price is say 120. The other investor gets in at 120. Now the price is at 135, and you get out and you're saying that I got a 35%, the other guy's got a 15%. But if the price comes down, it's very difficult for us to go out at a stock level. But let me see the deterioration of return that happens once you change categories. So I hope you like the webinar. Okay, one more question, Govind. Govindji, hi. Mohit, you can also give a 1-year global access on this offer. I never tried other countries, sir. Mr. Govindji, you're always asking me free things, sir. I can't do a 1-year global free offer. I'm giving 1 extra year free. I won't be able to give you a global access to this. I must tell you that we are positioning the global prices very high. And in Marketmojo, obviously we've not increased our prices for a while. So I'm biting the bullet from next week onwards to go on to higher prices. I think 12,999 for 1 year plus 1 year free is an excellent price. You're getting it for almost 6,000 rupees. Please don't look at 3, 4, 5,000 here and there. If you want to extend, you can extend multiple years and you can lock that price in. But at this point in time, I won't be able to offer global package free with that, sir. With that note, I hope you like the webinar. Give us feedback. Please write to us in case you have any feedbacks so that we can make the next one better. I will do this every month now with you. And we will now crunch the time to shorter duration to see that what we are seeing when we're focusing on now duration, shorter duration rather than a 10-year period and all, how we are seeing improvement out there. So please stay with us and keep giving us good inputs. Please feel free to write to us if there's any inputs or any additions that you need to do. With that note, thank you for your patience. I've taken a lot of time and wish you a very happy Diwali again. Please wish your families as well. Thank you.